Okay, let's get back to business today. How many of you are looking for funding? Okay. So typically, first round of funding comes from your family, your friends, or even some investors might give you a small check without checking your plan and signing on a small piece of paper. What happens next? You might have to go to institutional investors for further funding. How do you prepare yourself for that further funding? And that's why we have today Pankaj Naik and Karan Sharma, both co-heading the digital and technology practice at Avendus Capital. I invite Pankaj Naik, please Pankaj, and Karan. Over to you, Pankaj and Karan.
Thanks. Thanks a lot. Hi guys. So we were checking over there. I'm pretty sure. This is supposed to be, this is supposed to be a workshop, and I and my partner in crime, Pankaj, will try and make it as interactive as possible. We try to put some structure to some pointers basis, the inputs that we received, basis some of the other stuff that we do. But really, it's about, it's really about inviting all sorts of questions and queries from your side, so that we can try and address this and make it really more like a workshop, aided with some slides over here. Very quick introduction so that you have some background. Pankaj and I lead the digital and technology practice at Avendus Capital. We are one of the leading mid-market investment banks, help companies on private equity and M&A advisory. And our area of specialization is really the new age digital and tech businesses. So we work with clients in the consumer internet, fintech, payments, software, SaaS, education tech. Those are spaces that we work with. Some of our clients have been companies like Book My Show, Quicker, ShopClues, Pepperfry, Zivame, Loyalty Rewards, FreeCharge. We've done a lot of M&A like companies like Taxi for Sure, Redbus, and so on. And we've seen these companies evolve over periods of time. So I think what we are going to really do over here is really give you a little bit of flavor of as to how these companies went through the kind of journeys that most of you are looking to get onto, and then try and share some specific questions. So we can get going. So in the last as well, but I think we'll have pretty much Q&A at every bullet point. Happy to do that. And the three sections I would like to cover over here is really how do we really prepare for a fundraise process. Yes, the preparation does vary from stage to stage, does vary from the kind of business you are in, but there's certain basic principles. So try and cover that. What are the key terms of investments? This is a typical question that our friends who are starting ventures, they give us those calls right in the middle of the night that, hey, I'm negotiating this thing. I've received a term sheet from a VC. Can you give us some inputs over there? And so that is something we'll try and cover. Happy to address any specific questions that you might have over there regarding any legal terms. And what are the other considerations that you must be aware of and must take into consideration when you are looking to raise your next round of financing. So first on the fundraise process itself, one question I think that's coming in is before you really get into the financing process is what is really the market perception? The typical conversation starters these days is how is the market? What is it looking like? The bigger guys are not getting funded. Where those billion-dollar transactions that were happening, 3 to 4 quarters back. So we'll try and share some perspectives. So what's the current state of the market? So Pankaj, why don't you try and give some flavor and add to that?
Sure. So look at the first 6 months last year, financial year, approximately $4.7 billion were raised. And that number for this first 6 months is $1.2 billion. So obviously, it looks that you're just there's no funding coming. But if you actually try and slice it, then you will realize that large fundraisers happened exactly in this period last year. So whether it's Flipkart's capital raise or Ola's capital raise or Snapdeal's capital raise, there are 200 million plus capital raises. They all happened in exactly this 6 months. So obviously in these current year 6 months, no $200 million plus capital raises have happened. So it looks like the bottom has fallen out. But if you actually look at the 50 to 200 and 20 to 50 million and 0 to 20 million brackets, then actually the situation is not that bad. Maybe it's 30% down. 50 to 200 bucket is say 35% down. 20 to 50 is around 25 to 30% down. and 0 to 20 is almost like maybe 20-25% down, which is bound to happen. So we talk to VCs, we talk to mid-stage investors, and people are looking at transactions. People are willing to put money. People have raised their respective funds. Some of them have raised funds for India-specific purposes. So everybody is actually still looking for investing into companies. Obviously, on the other hand, a lot of them are also looking to get some exits so that they can show to their LPs that they have made those 5x, 6x, 7x, 10x that are at least are seen on the paper, but there is no liquidity as such for their LPs. So obviously, on one hand, they are trying to find liquidity. On the other hand, they are still looking to invest into the companies.
Yeah. But I think just to add to that, not happening as much. Though the good story is, or the good part is, we have at least 8 to 10 investors who have raised pretty large early stage funds. So certainly they would have to deploy that capital. So it's more of a wait and watch at this stage. So even though there's some revival in the larger transactions, the mid-market size space, $20 to $200 million, seed and Series A certainly is going through some sort of a drought at this stage. Then the next question that typically is about timing, and if I'm saying this part that if investments are really dried down at the early stage, then is this the right time to be approaching the markets, or we should really wait out for the markets to revive? And I think, as the saying goes, there's no right timing about it. In fact, most of the companies that we see, most of our clients who have become successful down the line, pretty much we can say most of them have raised capital in tough markets. And most of them have raised the initial capital and not so crazy valuations. And still they've gone ahead and built large businesses and created large value for the entrepreneurs and as well as the investors. So there's no right timing to it. In fact, at this stage, the feedback that we get from VCs when we are advising companies and we talk about what you're seeing in the early stage is really a lot of Me Too businesses. So the 20th fintech or the credit lending model or the 30th Baiju equivalent. So they keep seeing all of those businesses, and still they're spending time on that 25th business, which means they are interested in the space. My concern would have been if they were shooting down the second credit business as against the 25th business. So which means they have the time, they have the capital, they have the intent to deploy. So from timing perspective, in fact, I think these markets could be as good as it can get, because frauds are settled down. People can see through business plans. People can see through the quality of the entrepreneur, the kind of rigor he has put in, or the kind of gumption with which he's going to build the business. So that persistency is something that is really seeking. What's the sense of domestic foreign investors? I think a Series A and seed largely is going to be largely domestic investors. By domestic investors, we mean folks who have their India presence per se. Most of the funds are international VC firms, so I'm considering them as domestic investors here. So to expect that some family offices from China or a lot of early stage investors from US will start building the large portfolios in India, I think it's still some time away. They might do one-off deals. It's very difficult to manage an early stage portfolio in a different geography where you don't have as strong a presence. So I think whatever set of investors we have over here is something we have to deal with. I think what alternate pools of capital that early entrepreneurs can really tap into is something where you can do a little more work. These pools of capital are available with large Indian family offices. They have gotten more comfortable with this class of investments. This asset class has started to pick up in a good way. You have good wealth management businesses which are run by professional advisors. We also run a wealth management business. So is a few other Indian financial houses. I think those houses also act as a good source of funding for their clients to help them invest into this kind of an asset class at an early stage. Similarly, I think corporate VCs is a theme that we can expect to see some revival. We do see the offline guys get a little more comfortable with the space, so we can see a little bit of those kind of investments as well. I think the current market, I think it's not as relevant, this question at this stage, at an early stage of the company. And I think IPOs, we are still some time away. It's going to be more M&A. So coming to the meaty part over here, which is how you should really approach when you're looking to raise capital. What are the kind of prep work that should really go into? And that's what we'll try and cover over here. One thing which is really core to any business, and I think I'm not sure how many times it's already been repeated, but even when we are catching up with early stage companies over here or ideas over here, it's really about explaining what you are doing. So just explaining I'm doing this, as against focusing on the value proposition. I'm not sure people are interested to invest into another online payments business or another online education company. I'm an app driven online education company. That's a description of the business. That's not the value proposition. So I think it's very important to really define the value proposition early on, and it need not be a disruption. It need not be how you're disrupting something, but what is the value proposition which you are focusing on, and hence over the next 6 to 12 months, your efforts are going to really build that moat within the company, and that moat is something which would really attract interest from these investors.
Yeah, just to interject here what Karan said, there are two types of value. Karan said could be the disruption or are meeting some pent up demand, and those are one category. The second category, there are already things that are being done in the market, but for some reason, obviously, you think that the consumer is not getting the right value proposition from the current players who are in the market. So you're trying to do something faster, better, cheaper, and using technology to enable it. So when you're going out and talking to people, you need to be very clear. Is it just something totally new, or is something which is far better version than what's currently happening in the market? And you need to be very clear about that.
And again, then this X player, or my algorithm works better than say an Ola's or Uber's algorithm, because you certainly won't have a proof of concept over there. You certainly won't have those many instances to really demonstrate that. So it's very important to really bring about what the core value prop is, as against trying to just peg to some other player and trying to say I am better, I am cheaper, I am efficient, because you won't have the proof for that. You won't have as many instances to really demonstrate that. I think next is the storyline, and I think this is where we have seen things go haywire. It's very important to have the storyline. The storyline could be the pitch, and that pitch not necessarily has to be a deck or a pitch deck. The storyline is really in the next 10 or 15 minutes how you can really explain your business, how you can share as to what the core strengths you're bringing to the table, and hence how you're well equipped to deliver that kind of a value proposition. And I think the best to follow it up with this with that 10, 15 or 20-minute storyline is really demonstrate what the product is. I think end of the day, product will do the talking, and unless you're really at an ideation stage where there's no demo also available, it becomes very difficult for at least institutional investors to take those kind of projects forward. I think this third part is something which is not only a challenge at an early stage. We have seen this challenge even at Series C, Series D stage companies, where they do not have a clear articulation of the market that they're going after. Are they going after an additive market? Are they going after a complementing market? Or are they going after a substitute market? All these are very, very relevant, and more so I think first from the supply side. Typically what happens is there's a lot of focus on the demand side. This is the way I'm going to get consumers. These are the number of consumers who could really adopt to this kind of product or this kind of a service. But there's really no focus on the supply side as to what I'm now going to really deliver as a solution to the problem. That articulation is usually missing. So it's very important to have a very tangible explanation and articulation of what the market opportunity is. I think first from the supply side, and try and bring about what you're really doing. Will you add? Will you substitute? Will you complement? Or will you just improve the efficiency? And then, yes, when you sort out that supply side, what is the kind of user or consumer adoption you can get for that kind of a solution in the market? Rather than saying we have these many 100 million smartphone guys, out of this something that top down, I think something which doesn't take too many businesses forward.
I think one important thing here, Series A or Series B, these investors are looking for outsized returns, right? Of course, they're looking for 10x, 15x, because not all their investments are going to be happy. I think two things that are most important to them are, one is quality of management quality of founders, quality of individuals, which you are what you are. So that is one thing. The second thing is, the size of the outcome, and size of the outcome depends on size of the market. So you might have built a fantastic product, which actually, you do everything right, all that, but ultimately you will get to a $50 million top line. That is not going to solve the investor's problem. It might be a good business to run eventually as a family business, but that's not people are solving for. So make sure that you do your work on what actually is the opportunity size. What is the total size that you're solving for? Do some gesticulations, approximations, but have some sense what is it that the total addressable market and what is the kind of market share that you eventually might get if everything works well. Because the assumption is everything works well, and if you need to have that conviction. But even after that, there has to be an outsized outcome for you as well as for the investor. That's very key.
See, to share some examples. Yes, absolutely. So, it might sound a little funny as to, when you're starting off. So let me take the example of a company named Red Bus. They pretty much built the world's largest bus ticketing business. It was an India first business. So this is not a me too that, till that time we didn't have the concept of Uber of X. So they built a large bus ticketing business. And so the idea always originates from, a problem that you're trying to solve. So when Funny and Charan and the team, they really found out that they couldn't, book tickets on a Diwali weekend to go home, even though they were seeing some buses going, one or two seats empty, which means the market was inefficient. So they worked on the product, they worked on what they can do, they can build those ERPs and try and connect the ERP solutions to a consumer ticketing kind of a platform to make the marketplace more efficient. But right at that stage, they also went about what this market is all about and what this market is today and what this market could be. This is at that stage of the company where they spent hours and hours going through every damn bus association which really existed in that part of India. So market size need not be, okay, what's the India market size? What's the market that you are going to play in the next few years? Where they went about each and every bus association, how of that bus association, how many bus operators are over there, and hence basis that bus operators, because once you start getting into sizing the market, you understand the issues. So over there, people said that actually we don't have an issue of really growing our business. The issue is more about just the efficiency of the distribution, which meant the way they were sizing the market was how many routes are there, how many services are being plying over there, what's the typical occupancy rates over there, and then you multiply it with those bus operators and those bus associations that you do for a state, and hence you replicate the same thing for another state and look at what kind of market opportunity presents itself, and basis that what is the current underutilized capacity that you can compute. Because end of the day, that will determine whether you're going to be a 1% take rate business or a 10% take rate business. So unless you're not really estimating the market, how would you even know what your economics would look like? Because if that was a business where occupancy rates were 90-95%, which meant for the additional 5% efficiency, if you were able to bring to a market, I'm not sure what kind of unlocking of value you could do. Similarly, this concept was really about improving the efficiency as against the concept that we were saying, additive or substitutive. Then they took the argument forward that as a bus operator, if you see your data, for the last 3 to 4 years, you're flat at 20 buses. You're not growing more. Why you're not growing more than 20 buses? As an operator, you should be growing more if you're saying your business is doing well. The reason for that is they were not very clear as to if they invest another asset on a particular route, what is the kind of occupancy that will come out? Because there's no market data available over there. And again, they spent a lot of time that if we are able to overlay the data of other service providers, or if you have to generalize and plot the data for that route, then can we use that insight or that input as a business input to you? So now the market input is being used as a business input that these particular routes is where maximum demand is coming in and the supply is short, or these days of the week is where the demand is short, and hence maybe on these 2 days you can divert some of your supply only to these routes, and for rest of the days you continue to operate on your standard stuff. So once you get on the journey of defining the market is where you start peeling the onion, and I think that throws up a lot of inputs on the business side, and it also throws up inputs on what your commercials are going to be, what your unit economics will be. Now, let me take a very different, it's an important point, so spending a little bit of time on this. Let me take a different case of, say, a company like a Taxi for Sure or an Ola. When they started off, the way to look at the market was not so much as how many cabs are there. So I'm just changing the argument. In Red Bus, it's really about how many buses are there. Because if you see the number of cabs, if you read the data from the Ministry of Road Transport, the number of commercial vehicles in India, we have those, yellow plate commercial vehicles. So number of commercial vehicles for the last 7 years were flat at between 900,000 to 1 million. These were flat for the last 7-8 years, and which meant that either they were already being used in a good way. Most of these commercial vehicles for those call centers and BPO, employees being ferried between the city and the office. And if they were to build that business around, they'll take a percentage of those vehicles and try and get them on board and then run a business and then earn a commission. I'm not sure that business would have gone anyway, because here you could not replicate the model the way it was happening in the West, because Uber in the West does not, the underlying asset is not a commercial vehicle, the underlying asset is just a vehicle. Hence for them, market sizing was more about how many urban commutes happen in the city. Or the urban commutes were the kind of time and the kind of price or rupees or cost per kilometer and cost per minute that a commuter is really spending. And hence what's the kind of share of wallet you can get from that kind of commutes that are happening. Similarly, when you see a hotels and an alternate stay business, the way to look at the market need not just be what's the number of hotels and what's the number of properties that I'm going to aggregate. It's really about what's the number of overnight trips that are happening, and hence what's the kind of people who are really staying over in this country whenever they take an overnight trip. So the overnight trips could be air, could be rail, could be bus, could be car. And where are they today staying overnight in that city? Are they staying in an obligatory way with their relatives, or they're staying in a hotel, or they're staying in a guest house, or they're just staying in a bed and breakfast? That is a way to look at the market in that sense, and which will define as to where those gaps in supply and demand are and how you want to solve that problem. You already have a product, you already have something built in, but which part of the market you're better equipped to solve the problem for. I think it's also important to be familiar in your story, in your prep work about the ecosystem. So hence, what is the real landscape? What is the domestic international benchmarking? And in some of those early stage pitches, at times, it's just certain logos thrown in. But it's very important for in a story to come out that you understand how these businesses are operating in other markets, which means you have gone through and learned from the history over there. You also understand what kind of economics they are working on, what kind of capital really went into in those respective markets to help make a business reach a certain level. I think that awareness is very critical, and again, to some extent, it's also linked to the market articulation part. And this is something, here also a lot of learnings here. I mean, we have seen businesses which are valued at a few $100 million today, and if you ask them even today what your unit economics is going to be in the next 2 to 3 years, they don't have a clear answer. I'm not sure that is the position you have to be, especially when you're starting off. No one is asking you to guarantee those unit economics, but you need to have a view of that. What is the kind of revenue pool which would exist in the market based on the kind of market sizing you're doing, and hence from the revenue pool, what kind of economics you can really make. If the current revenue pool itself is so slim that you can't, for you to take a part of that is going to be a challenge, which means either the problem that you're solving is really not a big problem, which means the problem that you thought about of solving and is just a product which is more a feature, maybe so it's not as deep a market. Or second is you're not figured out the supply side over there, or you're not figured out what the consumer is really wanting, and hence whether it is unlocking, whether it is efficiency, whether it is additive, you're not solving the right problem. And that iteration is really important upfront to figure out, because that will also sharpen your vision on what's the problem you want to solve. But again, folks, the caveat over here is, if that is the way with which say a WhatsApp would have built the business, and certainly they won't have gone beyond day one. So we're generalizing a lot of these things. There's always going to be certain aspects There are always going to be certain ventures that you start off with a passion with just trying to solve a very, very big need, like Facebook trying to just solve a big social need, and then maybe reach a certain traction and user base where you can think about monetizing. But again, over there, it is more a future state of unit economics. So these businesses are more what we call as EV by user kind of businesses. But again, where the underlying is, what is the unit economics over there would drive from, what is the kind of traction you have, what is the kind of engagement you have for the user, what is the kind of mind share you have for that user, and hence, can you monetize it, how others have monetized it, and hence what could be the potential economics of that business maybe 5 years later, until for the next 4 years you might not have any economics at all.
I'm very passionate about this point. Obviously, Facebook, WhatsApp were built not completely looking at a unit economics of a user that is being added, but eventually they started in a market where there is enough conviction that there enough users keep coming, then eventually you'll make a lot of money. I think that correlation still now has not been proved very well, especially on how digitally you can monetize a customer in India if there is no transactions. But more importantly, my suggestion, if you're building a business, build a business for eventual profitability and making cash. You can't and shouldn't be building a business to be sold because I have X number of users and somebody might show up and just buy. The businesses that are built just with the focus of being sold are never the businesses that eventually get sold. The businesses that are built to last are the businesses that are being bought by people. Please keep that in mind, and ultimately, if you're building a business that is going to last, you need to know how you're eventually going to make money out of it. And you might go right, you might go wrong, you might 20-30% deviate here and there, and investors understand that. But they want to see that you have hunger to make money eventually, and you need to show that.
Sure. And the next one is, I'm not sure any VC, you really can't say at an early stage, this is my advisor or this is my finance guy, he knows the metrics, I just know the vision and product. Completely unacceptable. I think I'm yet to come across any of our successful clients where the CEO or the co-founders do not have the operating and financial metrics on the tips. If that is not the case, then you're not eating, breathing, sleeping that business. Then you're just trying to solve one aspect of the overall picture, which is something which investors are not at all comfortable. So I think numbers have to have tips. Otherwise, there's no solution to it. I think the last point is an interesting point because once I was in a meeting just within my early stage company and I saw 3 co-CEOs. So the 3 co-founders were also 3 co-CEOs, and if you ask them as to what they respectively do and why their title is co-CEO, it was all about we are all 3 equals and hence we are all 3 co-CEOs. And I think those dynamics are very important. It's very important to segregate shareholder when you have a co-founder as a shareholder, and co-founder as a business manager. And I think that's where those dynamics come into picture as to how mature this team is to really differentiate between both. That you have a co-founder who could be an equal shareholder in the business, but that doesn't mean he has the same role that you're doing. If he's doing the same role that you're doing, that means you're half capable and he's just plugging in the other half. And that is not a team that any VC would like to back. And those dynamics is very important for because most teams will have co-founders. For the team to really sort out at the beginning, it also demonstrates the kind of leadership that you have. By leadership, I'm not saying that who is the CEO and who are the followers. The leadership that and the maturity that each team member has over there in terms of what their role is. I think FAQs is an interesting thing, where I think as part of the storyline, try and anticipate issues beforehand and having an honest response to it. If you are still to figure out certain aspects of your product or a tech, just express that you yet to figure it out, as against because you won't have a long time period or the mental attention to really defend some of those issues. So better is to be honest, and that will come out as genuine.
Yeah, so just to add here is an anecdote. I've seen Andreessen Horowitz. and he was explaining how they, look at founders when they come and pitch their stories, and they have elaborate process in terms of shortlisting for a Monday morning meeting. So if you make it to the Monday morning meeting, then you're better than the 100 companies that they have evaluated. So he said that, and we obviously keep asking questions and sometimes push people at the back foot, saying that, but hang on a minute, why don't you do this in not the manner that you're doing, but this way or that way? And he said, I usually do it, and when that young guy looks at me, trying to be polite, but his eye says that, look, I've been doing this for 5 fucking years, and you're telling me to how to do it? Are you nuts? That kind of look, that kind of conviction, and later on followed by the analysis of why I'm doing what I'm doing and why you are wrong, is very convincing.
Is over here. I like to invite any questions that you might have on just the prep work, and maybe you can move on over here. Cool. So maybe we can park till then. So on the distribution outreach, I think this is something that's a typical question. Being advisors, given that we work at later stage companies, Series C, Series D stage onwards, the typical question that we get is, do we need an advisor? And when our humble feedback over there is, I'm not sure you need an advisor to help you run a process at an early stage of the company. Things are not as complicated. I think you would certainly need help from different people, and help could be, because you're so stretched on different aspects, you might need help on, some inputs on how you should, articulate some of the story, how you should go about sizing the market and refining the business, or how to, put a financial plan in place. I'm a tech guy, I've never, put a financial model in place. I have all the drivers identified. I know what the revenue drivers are, I know the cost drivers are, but I really don't know how to, really project it out. I need a sounding board. I need someone to critique what I'm putting together. I think those advisors, I would say, are more informal advisors. These could be experts who do this for a living, and build a rapport where you get those inputs. Either these could be friends, or these could be just professional relationships that you get those inputs in. But our view is, at an early stage of the company, if you're going with an advisor, to some extent it might dilute your own conviction and your own confidence in the process. So I think it's better to go all alone at I would say till almost like a Series A or Series B kind of a level.
If you need help, keep him at the background. Investors at Series A level generally don't like that, there is someone else coming along with you and negotiating on your behalf. So if you need a helping hand, and even if it's professional or personal, keep him at the background. But at this stage, we would advise you to have discussions yourself.
Because that is what is going to really negotiate with your customers. How are you going to really build a team? How are you going to really attract talent? How are you going to really talk tough to them? And very important for the investors to gauge, how do you really behave in a tough situation when you are all alone? Because that's what most founders will be in most phases of business. I think the next point is really the process design. I think this is something really important, because what happens is, as you have an idea, you start talking to people. Hey, what are the VCs what are the angels can you just start making introductions? I think that's the biggest mistake you can do, because it's very important for you to treat your business pretty much as a very sacrosanct kind of thing. Give it the right respect. If you build a business, think about what's the best way to build the distribution over there. By distribution, I mean distribution towards financing. And very important to design the process over there as to what are the kind of investors you think are best suited for you. What is the kind of capital you're looking at? What's the quantum of that capital? And then start researching for, is that quantum of capital, is there certain strategic synergies where we can tap into certain corporate VCs or certain family offices or certain just ultra HNIs who have experience in the space. Basis that you design the process, that as part of my phase 1, these are the number of investors that I'll try and reach out to. This is the way, my mode of pitch is going to be just sending a 2-liner about me, giving a view of what I'm trying to build, and then set up a meeting and then explain the whole deck. Typically, you see this, founders send out their presentations, their plans with an email. into a pretty much like a mail blast. I think that is not something that a VC or an angel investor is looking at. They're doing a mail blast. He's seeing who is trying to reach out to him and through what structures. I mean, you would pretty much, I think in this world, especially in this kind of community, you'll have maybe 1 or 2 degrees, 2 levels of separation with the one that you're trying to reach out. So that effort that you're making to get a warm connect to an investor, and the reason why you're making that connect is all part of the design. And I think that really defines the kind of success you can meet into a fundraising process. And most times people just jump into talking to investors without realizing, are these the right investors to talk? By the time you spend the next 2 months talking to the wrong set of investors, you are tied down, your business has gone nowhere, there's a lot of fatigue, a lot of people in the market know that, okay, this guy had also come to me, this guy had come to me, I had passed him for this season. So you've already created a lot of unnecessary negative buzz about you without reaching anywhere. So I think whom to target is very much part of the process design. This is again part of the market sizing opportunity as to who are the kind of investors who back companies in this kind of spaces, in these kind of business models for this kind of ticket size and this kind of a funding team. There's ample data available on all these 4 aspects. So important to do the process design and whom to target. How do you approach investors? I think over here it's very, very critical that you try and find warm connects into investors. So when we talk about do you need an advisor? So do you need an advisor just to reach out to those investors? No. But try and build those relationships with people, with folks, with friends, explore your network where, because as I mentioned, there will be at best 1 or 2 degrees of separation between you and the investor. Try and find a warm connect. Try and find a good perspective that introduction can do or that person can do while making the introduction. I think that's the best way. If you are whatever VC say, you drop this plan on my website or just send this an emailer, I'm sure that will get lost out. So if you have to really design the process and increase your chances, try and find a warm connect. Also, I think as part of events like these, I'm not sure someone would have the mental bandwidth to really recognize as to this is 5 minutes that this guy spent with me, unless the slide 1, which is your value prop was so strong that one-liner stayed with him. So I think these events have to be used in a way where your story is so crisp and articulate in your mind, where again you try and set up a prior meeting with that investor or that angel in this event, where you maybe drop them an email. That email maybe could be cold email if you're not found a connect, that you're visiting this, I would need 2 minutes, I'll try and find you out, and I'll just explain my business to you in 2 minutes. So there's some structure to it as to they should know you're really working towards a plan. And how do you engage with investors whom you already know? So there will be certain investors where the connects have already happened while you're still making the business plan. I think it's very important to keep the engagement level with them. What happens is you got introduced to certain investors, you were not ready with your process, your design, your product, your demo, you just forget them and park them aside as visiting cards or as just contact details. Then I'll reach out to them at some stage. Then when you start to build the process forward, where you now want to start formally reaching out to investors, is where you again ping them. But you've already lost that kind of warmth which was there in that connect. So if you already know someone, keep them engaged to certain things. Share with them certain articles that you come across in the area that you're building something, and say this is something that I'm trying to work on, or share some progress with them that this is how the product is shaping up. We have tested it out at these places. These are the early results. Some of them are disappointing. These are the issues that we identified, and hence this is what we are working upon. Rather than just saying that these are the metrics we have achieved. Talk about what you are learning over there. Keep that engagement. Whether that investor is reading it, not reading it, it's important to have that engagement going with them, so that it's still a warm lead by the time you want to launch a formal process. I think it's all about, all these aspects is really about improving deal certainty, and again our view is whenever you're stuck up into a situation where you have an investor in hand, a bird in hand, I think take it. And by no means we are saying, but take it in the sense that try and convince them, try and put certain structures, try and define certain milestones. The only disconnect, only trade-off is going to be between valuation, which the belief could be as you go more wide, you'll have a more market price discovery as against a price that someone else has given it. Basis your own financial plan, basis your own benchmarking and what you could be. If it is not way off, I think it's important to take that money. Taking the form and the shape in which you take that money is all dependent upon you. Maybe you can reduce the quantum, maybe you can work around other terms, maybe you can try and talk about what if kind of scenarios, whereas what if you hit certain milestones, what if you hit your business plan, then is there a way to claw back some of that equity. So all those are aspects to cover, but it's very important to improve deal certainty at an early stage of the business, because at that time capital is pretty much as much a key input resource as the team and the product and the idea. So I think money in the bank and runway is something which will give you a lot of leverage as against trying to start a process where you have far less capital available to you, and I think that's the time you can end up making some wrong decisions. Similarly, these are all the what ifs. That what if you do this, what if you do that, and hence you can try and get those kind of upsides or clawbacks. This is something which we'll cover in detail early on. To some extent, some of the points over here will also be about where you already have a small existing investor, and which is like a pre-series A, an angel, and now you're doing a series A investment, and hence how do you really talk about discussion around change in any terms. You might have an HNI which might have very, very strong terms, which either you can't offer to the VC, or where the VC does not want that HNI to continue to hold those kind of terms. It's important to have those discussions around realignment of those terms as part of your process design, as against doing at the last minute when your negotiating power, your bargaining power is zero, because the HNI also knows that you have to now do this deal. So pretty much who will be squeezed in that is the entrepreneur. I think this is something which is around how you really go about investor selection and contribution for them. So I think the aspects over here is really, as we were discussing, diligence on the investor and the partner. Elaborate more about the thought process around financial versus strategic. There's certain businesses where the network effects really kick in, and you can really borrow those network effects from a strategic. And we've seen this play out in certain industries. Payments and fintech is one where strategic investors as minority investors makes a lot of sense. Similarly, there could be situations where already a lot of the infrastructure, a lot of the supply side, a lot of the demand side is already cracked in, and can you leverage that kind of strategic money that can give you a head start. So over here, why financial versus strategic is really about a minority investment as against a strategic event.
Ideally, your investors should have enough connects, power, and dry powder to invest into the next few rounds that you might would be raising. And if you're taking strategic money as a minority investor, then the strategic investor should be such that for an eventual strategic exit, you're not being considered as already owned by someone. So you're not limiting your options eventually at the time of exit. So when strategic investors are two types of strategic investors, I would call them strategic financial and strategic. The strategic financial are the ones who give the money and help you network, share best practices, but they are not there to take final control. They're just looking to make money out of the investment, at the same time get benefited because of the ecosystem that you're creating. Those are the best ones. They're the other ones who say that let me dip my feet in the water and see how it goes, and eventually I'm going to buy this company. So those are the guys who are, I would say, strategic, where even if they 30% stake, they having in your company will actually preclude you mostly 5, 7, 8 years down the line selling it to someone else. So be careful of those.
So in the bottom areas for you to do diligence on the investors, how do you, what kind of strategic insights they provide? Are they able to identify key business drivers and help you track those, and the future connects, and also can they really help you into potential exit. So I think this is what's real expectation that an incoming investor has for that relevant series. I think backing the right team. So hence again it all feeds into the story and how you really design the process. What is the investment thesis for the investor? If you are able to anticipate that, what is the kind of investment thesis he has to build, then that also has to be part of your story for that kind of pitch making. Not the story for explaining a product and your value prop and the team, but to make a little life easy for him to align in the direction that you want to take him. So what's the investment thesis for him? You should not project what kind of returns. We have seen in a lot of places that if you invest in me, invest in this company, this is the kind of exit valuation we'll have, and these are kind of returns you can make, this is the kind of IRR. That's not something that you can put in, but very important to show outcomes over there as to what this business would be. And if this business is what it is, what I'm showing 4 to 5 years later, then this is the way these businesses get valued. And hence that implicitly gives them an indication of what the potential returns they can make. Also important to at least not present it, but have an assessment as to what are the kind of exits which are possible in a business like that, and how do you really quantify? I mean, is this a business where M&As have happened? Is a business which could be of immense value for someone from a strategic perspective? Again, this we are talking about in the perspective where certain businesses won't have the financial profile even once they mature, once they are large in scale, to go for an IPO. And I think it's about getting to the right cap table, who all is on the board, what kind of folks are there. So these are all expectations over there. And also it's very important to demonstrate the confidence on you as an entrepreneur, you as a team, on getting in follow-on financings, because that's what is going to keep the ship going. So I think these are certain aspects that will really come out in your story, in your discussion, to give the right comfort to an incoming investor.
So with the investors, you will also realize, find a right guy immediately in first couple of meetings, but at least you would know who you don't want to work with in first 2 meetings, right? So, and it's a partnership, at least that goes for between 3 to 7 years. So please make sure that whoever you're getting into your company, you're comfortable working with him, you're happy working with him, you're on the board with him. And that doesn't mean that he's not going to be painful and asking you difficult questions, because that's what his job and that's what he's supposed to do, and correct you if you're doing something wrong. But if you think that there's no chemistry in certain individuals, then you probably might want to think twice about getting that investor on board, because otherwise it's all 5-7 years of discordial relationship is not going to create a great company.
I think we're trying. So I think business momentum is very critical. I think those trends have to come out. If the business momentum is not there, and you expect that this should come back maybe in the next 1 or 2 months, where you start seeing that traction, better to launch the process then, as against explaining that 2 months later this is what I'll be. So very important to maintain and build that business momentum in that process, both going in and while in the process. Important for you to have spoken to your seed investors, to key market influencers. If you have a business in a certain area, it's important for you to engage with the market influencers, some of the industry leaders over there, some of the folks who people see as influencers, to at least they should be aware of what you're doing. You should have some validation from them, you should engage with them, and obviously you should try and explain and bring your seed investors on board what you're doing, how the business is performing, because this is the first diligence that any incoming investor will do. If it is a business, if if you're working into a certain area, they'll talk to your potential clients, or by potential clients I mean these are kind of clients you'll tap into, and hence it's important that those influencers have a positive feel, there's a positive vibe going for you, and so is the case with your seed investors, where they believe that I've invested in this company, I think these guys rock, they've been doing well, I understand they're looking to raise their next round of capital, I think you should certainly back them. It's a good team. That is important. I think confidence and demonstration of a meaningful exit is something we discussed, the process, and being visible in the market is also a key part as to how to really break through that digital clutter, because you'll have 10, 15, 20, 30 companies in your space. So I think being visible in the market is very critical. And I think over there, again as an example to quote is, I think you should see the way Redbus really managed their PR. They never had PR. They never had a formal PR agency. They never had an internal PR guy. It used to be a CEO who used to manage it. And never ever, they came out with stories that Redbus is doing this kind of business. These are kind of metrics they are talking about. All news articles that came about them was as to this is the way they're solving a problem in India. The India specific problem they're solving. It used to be covered in World Economic Forums and those kind of aspects, purely around their innovation, purely around the impact that they were making, the impact on social lives of some of the operators, the impact on some of the consumers. So that being visible in the market is important. Again, this will vary from depending on which stage you are in. So I think pretty much we are in the last leg here, and some aspects I'd like to cover over here is what is the key terms that you have to familiarize yourself with. It's important. All these terms are fairly standard. It's important for you to know about them, understand what they really mean, and so that when you are in those discussions with those investors, if some of these things come up, you don't draw a blank face, and also you understand the implications of what you're really signing up to. And some of these terms you try to put in over here. Liquidation preference is a key part, and we've seen most companies, most entrepreneurs do not get it, and this is something you should focus on. We are running out of time. I would love to give you a little more detailed perspective around it, but this is something which is you'll see a lot of material available on this. But this is one thing that you should get very familiar with. It will have at least 10 or 15 flavors to this kind of a ride. Similarly is the other part that is coming, which is vesting of existing funder shares, especially the implications in terms of event of an exit. Typically some VCs do require that even though you're starting this business 100% owned, 50% by you and 50% by a co-founder, they put certain vesting schedule of that equity, which means that today you as founders, how do we really know that you will continue to rise and grow as the company matures, and hence would you be the same co-founders, you'll mean the same co-founders of the company as you are today 3 years later. So hence there's a vesting period. It also factors into certain aspects when a co-founder leaves and the other co-founder continues, what is the commercial shareholding implication of that. Similarly, exit rights and cut-off mechanisms, anti-dilution, how the governance structure is going to be, affirmative vote matters, what are the kind of representation warranties you're doing, the kind of events or default you're signing up. Believe me, whenever someone says this is a very standard, this is very legal, no, it is not. There is nuances to every right, every word over there, and hence whenever you're signing up your, do not be penny wise, pound foolish over there. Here you need to compulsorily invest into a legal advisor, and please appoint a legal firm. Do not do this on your own, and get those inputs on each and every aspect. Question it, use it as your first time learning exercise, rather than assuming that if I question a lot about this, how will I be seen by the VC, or is this something which is very standard where someone else is saying that. So these are some of the aspects that you must look into. So these are the pointers which any term sheet comes to you. It's almost like these are aspects that at the bare minimum you must have to consider.
And all of these will have lingering effect on your company's next fundraisers. What you have given up this time will come back to haunt you next capital raise as well. Every new investor coming in will always cite a precedence, but you did give that in the last round, why you're not giving it to me? Obviously, as company grows, some of these onerous clauses keep getting diluted, and obviously that's a matter of negotiation. But in the first place, if you get some good terms on your side, that's far better. Right? You should know what you're signing up to, because a lot of times we've seen that people just don't know what they're signing up to, and that's why I think having a legal advisor is very important, so that you know exactly what you're signing on.
I think we are, yeah, please.
Can you elaborate the last point?
Yes, yeah, at times, we have seen a few documents, and when we're seeing documents, these are at a Series C, Series D stage. We have documents where uh, investors never have any incumbents on their right to transfer, because that is a core economic value. But you have seen that there are certain cases where investors have a free right to transfer. So this is a carve out that is very important. That till there is the cutoff period, till the time you are really committed to an exit period to the investor. Then in the next 5 years you will take this company public, or you will ensure a secondary sale of its shares, or you will ensure an IPO event happens or an M&A happens. And if that doesn't happen after 5 years, then there are a lot of the waterfall of rights that gets triggered in. But till those 5 years, till as an entrepreneur in the company, you have the opportunity to do that. You really can't go ahead and sell my shares to a competitor. A competitor could be direct, could be indirect, and at times you've seen in most cases this part is missed out. So where they have free transfer of shares, so it's a carve out you really need, and this becomes more critical because we started seeing investors investing into competing companies. We started seeing investors. Hence, if one of the companies could become larger, you could potentially get into this kind of a situation. So this is one of those aspects. Yeah. So I think this is just the last slide, and we'll jump into the Q&A after this. Is what's the right amount to raise? I think first principles along the market reality. What's the kind of investors? So I think what's the right amount to raise? That is what your business plan has to throw up. No two ways about it. Then you try and manage it through where the market is, where really the appetite of different investors lying it. I think valuation. So this is something that we do get asked as to what it really means, as to how do we value a business when there are no numbers. I think valuation is purely a function of what the market opportunity is, and hence what's the kind of revenue pool you could look at. What are the competitive dynamics, which means what is the kind of market share you will be able to gain out of that potential revenue pool. What is the capital efficiency, which is what kind of time you will take to break even, what are the kind of capital that will go into, what are the real unit economics, and hence how much more capital, how much more dilution you would have to do in subsequent rounds. Growth at time of exit, it's very important, because if 5 years later you're at 20%, you're growing at 20% as against 50%, whole lot of difference in the kind of exit multiple you can get in, because end of the day investors coming in today's valuation to have that view of what the expected return at that point of time would be. We have seen plans where you're growing at 200%, 300% for the next 2 years, then you start growing at 10% and 10%, because that's what the market cap is. I think that is not something which would ever be capital efficient, which would ever build a lasting business, as Pankaj was saying. Then certain thumb rules which people talk about at this series, this kind of dilution happens. These are kind of 3x, 4x, 5x returns depending on what kind of series A, B or C investor is coming in, and hence you are in that ballpark range or not. I think those thumb rules are also important, and similarly what the investor interest and the market sentiment is that point of time. So I think if you have to really look at valuation at an early stage of the company, what we really mean is this: outcome based pricing. What are the outcomes that you're able to demonstrate basis the kind of capabilities you have, basis the kind of value prop you have, the team you have, and obviously the market opportunity. What's the kind of outcome you can present to the market, and basis that outcome, what is the entry price at which an investor could come in, basis what is the level of certainty and the confidence and you achieving that outcome. So I think this is purely on the valuation, and yeah, we are pretty much done. This is just the last slide as a consideration key takeaway. I think get the right long-term legal advisors early. So I think we're certainly contributing to the business of some of our legal guys. Vendor due diligence is not so much at an early stage, so you can take that out. I think investor relations is a core KRA, which we were indicating towards. It's important for you to be in touch with your existing investors or angels, keep them informed what's happening, and also keep engaging with the external investors, people you've spoken to, keep them updated about what's happening. So pretty much like what the public markets do around investor relations, a private company should do the same thing. It obviously differs depending on what stage of evolution you are in, and I think critical to have a continuous inbound flow of investors. Important to keep building that inflow as against you reaching out to the market. As the last certainly is plan B. So Please.
I have a question that one of my closest friends actually has a very recent QSR business. Of late, I mean, after quite a few years in their journey, they are raising the first institutional round.
That their potential in the last few years hasn't been captured in the sense that the story has a lot of legs to go.
Sure.
They have probably a potential of growing 30 to 40 times from here on. But the point is that they are profitable. They are mildly profitable,
Sure.
and
Hi,
I
this
think
is
it is
Pankaj
work.
from Avendus.
Pankaj,
Hi,
your
I'm
mic is
supposed to
still
meet,
on.
So their mild profitability seems to be working against them in terms of valuation, which is strange to me. As in, what is happening is that the investors are saying that this is the P or multiple, or this is the way to value the entry valuation, versus let's say a loss-making company,
yes,
which they could probably have valued on the exit potential valuation. So,
Sure.
which making and I mean, I'm also building a business where I'm projecting mild profitability, and that scares me sometimes.
No, I think that if you're talking to investors who are trying to put a valuation multiple to profitability, I think it's irrelevant. What is more relevant is what is the core underlying business and what are the kind of economics you are building around it. There's certain businesses like QSR which have to be inherently profitable. So what you are indicating towards is that we have a cloud kitchen kind of a business. We have all these, a fresh menu or a Hola Chef, and they are being valued on a revenue multiple. And I am a QSR, which to some extent is in the same space, but I am being valued on profitability. Yes, you would have to be valued on profitability because your business model is very different. So this is one dichotomy that really comes in.
Even they have that exponential J curve model which
So,
can be blended.
so I think it's if you're able to demonstrate that that is the kind of growth you can achieve, and towards that incremental growth, so you have an underlying growth which is a profitable growth at which you're breaking even or you're making some bit of money, and that business is continuing. But at the same time, you're able to demonstrate through data by actually running it in a way that for that incremental growth, this is the kind of burn I am incurring, and hence you look at both of these aspects in a different way. People give you a multiple on the business. By business, I really mean a revenue. But frankly, if someone is telling that because you're profitable, I'm going to value on profitability, it's just a tactic that they're throwing at someone. But underlying is businesses in a certain aspect, in a certain phase of evolution, would be valued on certain underlying metrics. That could be EV by revenue, that could be EV by gross margin, that could be EV by EBITDA. But just because you're profitable, that doesn't mean. We are working with a company it's an overall tech play, not the consumer internet play, which is 50% EBITDA margin company. And over there, some investors push back that this business actually should be valued on revenues. And it's the other way around. So they're saying this business should be valued on revenues because you're 50% EBITDA, which means a 10x EBITDA multiple means a 5x revenue multiple, which 5x looks very crazy, but 10x EBITDA multiple looks so cheap. That's where you have to really get into why a business has to be valued on profitability. There's certain reasons to it, because you're able to demonstrate that financial profile, you're able to demonstrate your pricing premium, you're able to demonstrate your cost operating leverage, and hence this is something that you'll continue to defend, and you should be valued on EBITDA. And this is something which is highly recurring in nature, so there's a lot of visibility to it, so it's an EBITDA multiple. Similarly, if it is revenue, then you have to really demonstrate that you are already on that J curve, where you're investing into that growth, and hence because of that incremental growth, you're not profitable today, and hence you should be valued as a brand or as a business, and hence on the top line. So people will throw at that arguments, but underlying is you have to defend that basis the fundamental stage where you are in that business.
Yes. With the investor on the percentage of the stake in the company, besides the valuation of the company, what are the other things that the startup can look into?
So I'll take that. I think at this stage, especially at stage investors who want to come in, would like to have a influential role to play in the company. And that is the reason they ask for anywhere between 20 to 30% stake in the company. So special resolution has 26%. So typically they'll try and see if they can cross the 26% threshold. So ultimately, it boils down to the valuation of the company, right? Because then, if somebody wants 26-30% stake, then you should be asking for more money for it if you think that your company is valued more. But we haven't seen at a Series A level, people are just happy with a 10% stake, just because at 10% it doesn't give them enough influence over you.
Are an HR tech company, HR tech consulting, and we are planning to raise Series A. So could you please help us for the exit strategy? Like most of the time when we have a discussion with the investors,
Sure.
so a lot of emphasis on the clarity of the exit strategy. So
Sure.
if you put some words onto that. Yeah.
Sure, I think you talked about a very specific vertical, and we've done some work in that vertical. There have not been too many strategic exits in this vertical, and not many players have been able to scale up business beyond certain payrolls processed or pay slips processed. I think the biggest guys would be just under a million at best. So I think here, I think the way you have to position is that it's a software business, it's a SaaS business, and HR is a vertical that you're going after. And then I think for those businesses, I think you have to build the business case and the financial plan more from an IPO perspective, because these businesses beyond 1 or 2 rounds of financing have to become profitable. If they are not becoming profitable, that means either you're investing a lot in sales and marketing, if these businesses are catering international markets, otherwise they have to inherently become profitable. And hence there's always the first exit case in these companies will be an IPO, and that's how you build it out. And then gradually, I think that unlike a lot of other places where the first business case is in M&A, I think once you're able to demonstrate that, and as Pankaj was saying, if you build a strong business and if you are able to say that I can potentially take this company IPO in the next 5, 7, 8 years, then automatically that qualifies that there will be strategic interest because you'll be generating those cash flows. So I think here, in this space, unlike say payments, where you can always say these are kind of 100, 200 transactions happening, here you're better off positioning yourself as your exit case in IPO.
Okay. So MSME would be a good route to that.
MSME, it could be depending on you're targeting international markets or domestic markets. It could be both MSME even as well as the mainstream exchanges.
Thank you.
My
So-
question, sorry.
One small thing, as company becomes big by the existing investors, so that they get another 3-4 years runway before you actually go public. That's another way you should talk. So, for example, people like GA, TA, Warburg, etc., people come in at later stage when your tech company is grown. So they are not VCs, but they are growth investors. They are actually buyout secondaries of VCs. So that's another way of looking at it, just for you.
We'll just take the last question.
Technical, are you seeing kind of non-traditional structures in pre-Series A funding, like convertible preference shares? Because as you said, for a pre-Series A, there's really valuation is just notional concept at that
Sure.
point.
So I think
And
most
what's
common,
allowed by
yeah.
companies law as
So the
well.
most common structure that we're seeing in pre-Series A is linking it to the Series A and having a certain IRR discount per month or per quarter towards that. So I think that's the most common structure we are seeing, where the pre-series guy is not willing to price it, neither they know, and generally, so they pretty much link it to the Series A price and discount it back with certain IRR. So there's certain convertible structures. Absolutely. So that's a typical one that works over there. And over there, you can have the floor and cap both over there as well.
What could be the
Forget pre-series A. We're seeing all the way up to Series C.
Both this confusion: are you selling too cheap or are you selling too expensive? So actually, it works for both, because it also meets the financial profile or the investment profile for that pre-series investor, where he knows that if a Series A happens, this is the kind of return, that notional return which he'll be into, and then he really relies on the company growing from there on.
What could be the usual percentage of discount?
Usually it is 1 to 2% per month.
1 to 2% per month.
Yeah. So which means if you have raised the Series A 12 months later, then he would have entered at a 25% discount to that Series A valuation. Absolutely, we can take some of the questions outside. Thanks. Thank you so much.